I need to tell you something that Wall Street does not want you to know. The signals that actually predict market crashes are not complicated. They are not hidden behind expensive Bloomberg terminals or proprietary algorithms. They are sitting in plain sight, available to anyone who bothers to look. But the financial industry ignores them because acknowledging these signals would be bad for business. It would mean telling clients to sell. It would mean smaller bonuses. It would mean admitting that the models everyone relies on are fundamentally broken. I have spent my entire career looking at data that other people ignore. I shorted the housing market in 2005 and 2006, when every major bank, every rating agency, every government regulator was telling the world that housing prices could never decline nationally. I was called crazy. I was called a doom and gloomer. My own investors tried to pull their money because they thought I had lost my mind. But I was not looking at sentiment. I was not listening to experts. I was looking at the data, and the data was screaming that the entire system was about to collapse. The same thing is happening today. The same patterns I saw before 2008 are appearing again. Different asset classes, different mechanisms, but the same fundamental dynamics of excess leverage, misaligned incentives, and willful blindness to obvious risks. And once again, Wall Street is telling everyone not to worry. Let me take you back to 2005, because that experience shaped everything I understand about how markets really work. I was running a small hedge fund out of Cupertino, California. I had maybe $100 million under management. Nothing compared to the big Wall Street firms, but I had something they did not have. I had the freedom to actually look at the data without worrying about what it might mean for my bonus or my career. I started reading mortgage prospectuses, hundreds of them, thousands of pages of dense legal and financial documentation that nobody else was reading. Not the banks originating the loans, not the investment banks packaging them into securities, not the rating agencies stamping them AAA, not the institutional investors buying them, nobody. And what I found in those documents terrified me. The underwriting standards had completely collapsed. Loans were being made to people with no income verification. Adjustable rate mortgages were being sold to borrowers who could barely afford the teaser rates, let alone the fully indexed rates that would kick in after 2 years. The assumption underlying the entire market was that housing prices would rise forever, which would allow borrowers to refinance before their rates adjusted. But if housing prices fell even modestly, the entire structure would implode. I ran the numbers, I built spreadsheets tracking default rates, prepayment speeds, housing price indices, and debt-to-income ratios across every major metropolitan area. The data pointed to one conclusion. This was a bubble of historic proportions, and when it burst, the losses would be catastrophic. So I bet against it. I bought credit default swaps on subprime mortgage bonds. I paid premiums month after month while everyone told me I was wrong. And then, in 2007 and 2008, I was proven right. That experience taught me the most important lesson of my career. Markets can remain irrational far longer than most people can remain solvent. But they cannot remain irrational forever. Eventually, reality asserts itself. And when it does, the correction is usually violent and swift. Today, I am going to share the 4 specific signals I watch that tell me when markets are becoming dangerously disconnected from reality. These are not opinions. These are not vibes. These are quantifiable, measurable indicators that have preceded every major market dislocation in modern history. Wall Street ignores them because acknowledging them would require action that conflicts with their business model. But you do not have to ignore them. Here is what I am watching. First, the divergence between credit markets and equity markets. Second, the concentration of returns in a shrinking number of stocks. Third, the relationship between margin debt and market valuations. And fourth, the behavior of insider selling relative to buyback activity. Each of these signals is flashing warning signs right now. Let me explain exactly what I am seeing and why it matters. Let me start with the second most reliable signal, because it sets up everything else. I am watching the extreme concentration of returns in a tiny handful of stocks. This is not normal market behavior. This is a sign of a market that has lost connection with underlying fundamentals. Look at the data from 2023 and 2024. The so-called Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, accounted for essentially all of the S&P 500's returns. Strip out those 7 names and the remaining 493 stocks. We're basically flat. This is not a healthy bull market. This is a handful of mega-cap stocks, dragging a struggling market higher while most companies are treading water or declining. Why does this matter? Because narrow markets are fragile markets. When returns concentrate in a few names, it means investors are not confident in the broad economy. They are hiding in perceived safe havens, crowding into the same trades, creating a feedback loop where money flows into large caps simply because money is flowing into large caps. This dynamic works until it does not. And when it reverses, when even one of those mega cap names disappoints, the entire edifice can crack. I saw a similar pattern before the dot-com crash. In 1999, a handful of technology stocks were responsible for almost all market gains. The average stock was already in a bear market, while the indices kept making new highs. Investors felt wealthy because their portfolios showed gains, but those gains were entirely dependent on a few names staying elevated. When those names cracked in 2000, the carnage was historic. NASDAQ fell nearly 80%, trillions of dollars evaporated. The concentration today is arguably worse. The Magnificent Seven represent over 30% of the S&P 500 by market cap. That is higher than the tech concentration at the peak of the dot-com bubble. And unlike 2000, when technology stocks traded at infinite multiples because they had no earnings, today's megacaps do have earnings, but they are priced for perfection. Any disappointment, any deceleration in growth, any shift in the competitive landscape could trigger a violent repricing. I track concentration ratios obsessively. When the top 10 stocks account for more than 30% of index returns, when breadth indicators show more stocks declining than advancing even as indices rise, when the equal-weighted S&P 500 dramatically underperforms the cap-weighted version. These are warning signs. They tell me the market is being propped up by a few titans, while the underlying economy is weaker than headline numbers suggest. Now let me tell you about the most important signal I watch: the divergence between credit markets and equity markets. Credit markets are smarter than equity markets. This is not opinion, this is empirically demonstrable across decades of data. Bond investors, unlike stock investors, do not get to participate in unlimited upside. They get their coupon and their principal back, or they get impaired in a default. This asymmetric payoff structure makes bond investors far more focused on downside risk. When credit markets start pricing in trouble, you should pay attention even if the stock market is making new highs. Right now, I am seeing stress in credit markets that equity investors are completely ignoring. High yield spreads have widened from their post-pandemic lows. The cost of insuring corporate debt through credit default swaps has increased. Loan default rates are rising, particularly in leveraged loans to private equity-owned companies. The commercial real estate market is in genuine distress, with office building valuations down 30 to 50% and regional bank exposure to these loans creating systemic risk. But if you look at the stock market, you would think everything is fine, indices near all-time highs. Volatility suppressed, retail investors pouring money into the same mega-cap names. There is a massive disconnect between what credit markets are saying and what equity markets are pricing. I learned to respect this divergence in 2007. Credit markets started showing stress in mid-2007. Subprime mortgage bond prices were falling. The ABX index, which tracked subprime mortgage securities, was collapsing. Credit default swap spreads on financial institutions were widening. But the stock market kept rallying through October. The S&P 500 made its all-time high in October 2007. Months after credit markets had already started pricing in disaster. Investors who watched credit markets got out early. Investors who watched stock prices stayed invested until it was too late. By March 2009, the S&P was down over 50% from that October high. But credit markets had given warning signals 6 to 9 months earlier. Let me be specific about what I am seeing in credit markets right now. Commercial real estate is in genuine crisis. Office vacancy rates in major cities are at record highs. Buildings that were worth hundreds of millions of dollars a few years ago are selling for a fraction of that today or not. Selling at all, the loans backing these properties are underwater. Regional banks, which hold a disproportionate share of commercial real estate loans, are facing massive potential losses. We already saw the beginning of this stress in 2023 when Silicon Valley Bank, First Republic, and Signature Bank failed. Those failures were primarily about interest rate risk, but commercial real estate exposure was a contributing factor. The stress has not gone away, it has just moved out of the headlines. But the underlying problem, trillions of dollars in commercial real estate debt that cannot be refinanced at current rates, remains unresolved. High-yield corporate credit is also showing strain. Default rates have risen from near zero during the pandemic stimulus period to levels that are concerning, though not yet crisis levels. The leveraged loan market, which provides financing to private equity-owned companies, is seeing increasing stress. Many of these loans were made with floating rates, and the rise in interest rates has dramatically increased the debt service burden on already leveraged companies. The pattern preceded the 2001 recession. Investment-grade credit spreads started widening in late 1999, almost a year before the stock market peaked. The pattern preceded the 1990 Asian financial crisis, the 1998 Russian default, and essentially every major market dislocation of the past 30 years. Credit leads, equity follows. Ignore this at your peril. I maintain a dashboard of credit market indicators: investment-grade spreads, high-yield spreads, leveraged loan prices, commercial mortgage-backed security prices, bank credit default swap spreads. When these indicators diverge significantly from equity market behavior, when credit is pricing in stress that stocks are ignoring, history says the equity market will eventually catch down to credit market reality. The only question is timing. My third signal is the relationship between margin debt and market valuations. Margin debt is borrowed money used to buy stocks. When investors borrow to invest, they amplify both their gains and their losses. In aggregate, margin debt levels tell you how much leverage is built into the system and how vulnerable the market is to forced selling. Here is how the dynamic works. When markets rise, investors feel confident. They borrow money to buy more stocks, their profits are amplified, which makes them feel even more confident, so they borrow even more. This works wonderfully on the way up, but when markets decline, margin calls force leveraged investors to sell whether they want to or not. This selling pushes prices lower, which triggers more margin calls, which forces more selling. The leverage that amplified gains on the way up amplifies losses on the way down. I track margin debt as a percentage of GDP and as a percentage of total market capitalization. Both measures are near historical extremes. Total margin debt exceeded $900 billion at its recent peak. That is nearly double the levels seen before the 2008 financial crisis. Adjusted for inflation and market size, the leverage in the system is comparable to the most speculative periods in market history. Now, I want to be careful here. Margin debt alone does not predict crashes. It can stay elevated for extended periods. What I watch for is the inflection point. When margin debt starts declining from elevated levels, that is often the first sign that leveraged investors are being forced to reduce positions. In 2000, margin debt peaked in March and started declining before the Nasdaq reached its final high. In 2007, margin debt peaked in July, months before the market topped. The decline in margin debt is often a leading indicator of the decline in stock prices. I am also watching leverage in places that do not show up in traditional margin debt statistics. Private credit has exploded into a nearly $2 trillion market. Much of this credit has been extended to companies that could not access traditional bank loans or bond markets, often at floating rates that have become punishing as interest rates have risen. The stress in this market does not show up in public data, but it is very real. When these credits start defaulting in size, it will send shockwaves through the financial system. There is another form of hidden leverage that concerns me deeply: the proliferation of 0 days to expiration options. Leveraged ETFs and other derivatives that amplify market moves. Retail investors have embraced these instruments without understanding how they work or how dangerous they are. Every day, billions of dollars in notional value trade in options that expire within 24 hours. This creates enormous leverage and enormous sensitivity to short-term price moves. When volatility spikes, when the market moves against these positions, the unwind can be violent. Market makers who have sold these options need to hedge their exposure, which means buying when prices rise and selling when prices fall. This amplifies moves in both directions. The mechanics are complex, but the result is a market that can move far faster and far harder than fundamentals would suggest. I have also been tracking the growth in basis trades among hedge funds. These are strategies that involve buying treasury bonds while selling treasury futures, capturing a small spread between the two. The spread is tiny, so funds use enormous leverage, sometimes 50 to 100 times, to generate meaningful returns. The strategy works perfectly until it does not. In March of 2020, when these trades started unwinding, treasury markets, the supposedly safest and most liquid markets in the world, nearly broke. The Federal Reserve had to intervene with trillions of dollars to prevent a complete market meltdown. The basis trade is back. Hedge fund leverage in treasury markets has reached levels that concern even the Federal Reserve if another shock hits. If these trades start unwinding again, we could see a repeat of the March 2020 crisis or worse. My fourth signal is the relationship between insider selling and corporate buybacks. This one is subtle but powerful. Insiders, meaning executives and board members, have better information about their companies than anyone. When they sell their own stock in size, they are telling you something. And when companies use corporate cash to buy back stock even as insiders are selling, the signal is even more telling. Corporate buybacks have been a dominant force in markets over the past decade. Companies have repurchased trillions of dollars worth of their own stock. This reduces share count, boosts earnings, purse hair, and supports stock prices. It is financial engineering that benefits executives whose compensation is tied to stock prices and earnings, purse hair targets. But here is what bothers me. At the same time that corporations are buying back stock with shareholder money, insiders at those same corporations are often selling their personal holdings. In other words, the company is buying at prices that executives apparently think are too high. This is a massive red flag. I track the ratio of insider selling to insider buying across the market. When insiders are selling 3, 4, 5 times as much as they are buying, when this selling is widespread across industries rather than concentrated in a few names, it tells me that the people with the best information are heading for the exits. They are letting corporate buybacks support prices while they reduce their personal exposure. The pattern before the 2000 crash was textbook. Insiders at technology companies were selling like crazy throughout 1999. And early 2000, they knew their stocks were absurdly overvalued. They knew the fundamentals could not support the prices. So they sold, and then they watched from the sidelines as their former shareholders lost everything. I am seeing similar patterns today. Insider selling is elevated across multiple sectors. Some of this is normal. Executives get stock compensation and need to diversify. But the ratio of selling to buying is near levels that have historically preceded significant market declines. And when I see insiders selling while their companies are buying back stock, I know something is wrong. Let me give you a specific example of how this works in practice, without naming individual companies. A technology company is trading at all-time highs. The CEO sells $50 million worth of stock over 3 months. The CFO sells $20 million. Board members are selling millions more. Meanwhile, the company announces a $1 billion stock buyback program. The press releases tout management's confidence in the business, but the actions tell a different story. If management was truly confident, they would be buying with their own money, not just authorizing the company to buy with shareholder money. I track this systematically. I look at Form 4 filings, which are required whenever insiders buy or sell. I aggregate the data across sectors and across the market as a whole. When the ratio of selling to buying exceeds 4 to 1, when the selling is broad-based rather than concentrated in a few names, when it persists for months rather than occurring in isolated transactions, these are warning signs. The data right now shows selling to buying ratios that are elevated across technology, financials, and consumer discretionary. These are sectors where insiders should have the best visibility into future earnings. If they believed their stocks were undervalued, they would be buying. They are not. They are selling into strength while their companies buy back stock. There is one more dimension to this that I watch carefully: the timing of buybacks relative to insider sales. Some companies seem to deliberately time buyback announcements to provide liquidity for insider sales. The company announces a large buyback program. The stock rises on the news. Insiders sell into the increased demand created by the buyback. It is legal, but it tells you everything about management's true view of the stock's value. No, let me bring these four signals together because they tell a coherent story when viewed collectively. The credit markets are showing stress that equity markets are ignoring. Returns have concentrated into a handful of names while most stocks struggle. Leverage in the system is near historical extremes, and insiders are selling into corporate buybacks rather than adding to positions. Each of these signals alone would warrant caution together. They paint a picture of a market that has become dangerously disconnected from underlying reality, a market where prices are being supported by momentum and liquidity rather than fundamentals, a market where the margin of safety has evaporated. I want to be clear about what I am not saying. I am not saying the market will crash tomorrow. I am not saying I know exactly when the turn will come. Timing markets is extraordinarily difficult, and I have been early more often than I have been right on schedule. Being early is indistinguishable from being wrong in the short term, which is why so many people ignore warning signs until it is too late. What I am saying is that the probability of a significant market dislocation has increased substantially. The conditions that have preceded every major crash of the past 50 years are present today. Ignoring these conditions because the market keeps going up is how people get destroyed. The market was going up in 1929, right until it was not. It was going up in 2000, right until it was not. It was going up in 2007, right until it was not. Let me tell you how I think about applying these signals in practice, because knowing that risks are elevated is not the same as knowing what to do about it. First, I reduce exposure to the most vulnerable parts of the market. When concentration is extreme, the concentrated stocks are the most dangerous. Yes, they have been the best performers, but they are also where the most pain will be when sentiment shifts. I would rather own a diversified portfolio of reasonably valued stocks than a concentrated bet on the same names everyone else owns. Second, I increase allocations to assets that will hold value or appreciate during market stress. Short-term treasuries are earning meaningful yields for the first time in 15 years. Cash is not a bad position when risk assets are priced for perfection. Gold has historically provided protection during periods of financial stress. These are not exciting investments. They will not make you rich if the bull market continues, but they will preserve your capital if the risks I am identifying materialize. Third, I look for asymmetric opportunities. This is what I did in 2005 when I bought credit default swaps on subprime mortgage bonds. The cost of the insurance was tiny relative to the potential payoff if the housing market collapsed. I am not going to share my specific positions because they change and because everyone's situation is different. But the concept is important. When risks are elevated, look for ways to profit from the dislocation rather than just trying to avoid losses. Fourth, I maintain liquidity. The worst thing you can do in a crisis is be forced to sell. Forced sellers always get the worst prices. They sell not because they want to, but because they have to meet margin calls or redemptions or unexpected expenses. If you have liquidity, if you have cash on the sidelines, you can be a buyer when everyone else is selling. That is how fortunes are made in bear markets. I have always maintained significant cash reserves even when it hurt my short-term returns. In 2008, having cash allowed me to buy assets at prices that seemed impossible just months earlier. Corporate bonds from solid companies were yielding 15 or 20% because everyone was panicking and no one had cash. Those who had liquidity made generational returns. Those who were fully invested had to sell at the worst possible time just to meet obligations. Fifth, I mentally prepare for what is coming. This might sound strange, but psychological preparation is as important as financial preparation. Most people cannot hold through a 40 or 50% drawdown even if they know intellectually that markets recover. The pain of watching your net worth cut in half is overwhelming. It causes people to sell at exactly the wrong time. If you accept now that a significant decline is possible, if you mentally rehearse how you will respond, you are far more likely to make rational decisions when the time comes. I spend time visualizing scenarios. What will I do if the market drops 20%, 30%, 50%? Having thought through these scenarios in advance means I am not making emotional decisions in the heat of crisis. 6. I focus on businesses rather than stocks. This is fundamental to how I think about investing. I do not buy stocks, I buy pieces of businesses. When I own a piece of a business, I think about the cash flows that business will generate over the next 10 or 20 years. I think about competitive position, management quality, and capital allocation. Stock prices fluctuate wildly based on sentiment, but business values change slowly based on fundamentals. During the 2008 crisis, I was able to stay calm because I was focused on business values rather than stock prices. I knew the businesses I owned were still generating cash, still serving customers, still fundamentally sound. The stock prices had collapsed, but the businesses had not. That perspective allowed me to hold through the worst of it and even add to positions at the bottom. Let me also address a common objection because I hear it constantly. People say that everyone has been predicting a crash for years and it has not happened. So the bears must be wrong. This misunderstands how market cycles work. The fact that a crash has not happened yet does not mean the risks are not real. It means the timing is uncertain. But the risks compound the longer they are ignored. Every year of excess makes the eventual reckoning worse. Every year of excessive leverage, mispriced risk, and speculation adds fuel to the fire. The housing bubble was visible in 2003 to anyone who looked closely. It did not burst until 2007, 4 years of being early. 4 years of being mocked as a perma-bear. And then vindication came in the form of the worst financial crisis since the Great Depression. I would rather be early than late. Being early means you might miss some gains. Being late means you might lose everything. The asymmetry is clear to me, even if it is not clear to Wall Street. There is another dimension to this that I think about constantly. Markets are not just numbers on a screen. They are real money belonging to real people trying to secure their retirements, educate their children, achieve financial independence. When I see the risks building, when I see people oblivious to danger because their recent experience has been positive, I feel an obligation to speak up. Not because I want to be right. Being right about a crash means being right about something terrible that hurts millions of people. I do not take pleasure in that. But I would rather warn people who might listen than stay silent and watch them get destroyed. The financial industry has a structural bias toward optimism. Brokers make money when you trade. Asset managers make money when you stay invested. Analysts get better access when they say positive things about companies. The entire system is designed to keep you in the market, to keep you buying, to dismiss concerns as pessimism or fear-mongering. But the people dismissing concerns are not the ones who will suffer when the cycle turns. You will. I have no such conflicts. I manage my own money. I do not care if you agree with me. I do not benefit from your trading activity. So I can tell you what I actually think, which is that the signals I watch are flashing warning signs that I have seen before. Every major market event of my career, credit market stress, extreme concentration, elevated leverage, insider selling, all present, all being ignored. What you do with this information is your choice. You can dismiss it as doom and gloom. You can point to all the predictions that did not come true on schedule. You can tell yourself that this time is different. Or you can look at the data yourself. Check credit spreads, calculate concentration ratios, track margin debt, monitor insider selling, see if what I am telling you matches what you find. The data does not care about opinions. The data does not care about narratives. The data simply exists, waiting to be examined by anyone willing to look. I have spent my career looking at data that others ignore, and right now the data is telling a story that most people do not want to hear. I do not enjoy being the bearer of difficult news. I would much rather tell you that everything is fine, that you can stay fully invested, that the good times will continue indefinitely. But that would be dishonest. And I have built whatever reputation I have by being honest about what I see, even when what I see is unpopular. The truth is that risk management is not about avoiding losses entirely. That is impossible. Risk management is about sizing your bets appropriately given the probability and magnitude of potential outcomes. When the probability of a significant decline is elevated, when the potential magnitude of that decline is large, rational investors reduce exposure. They do not double down because the market has been going up. The signals are there, the warning lights are flashing. What happens next depends on how long the market can ignore reality. But reality always wins eventually. It won in 2000. It won in 2008. It will win again. The only question is whether you will be positioned appropriately when it does. I cannot tell you exactly when the turn will come. Nobody can. But I can tell you that the conditions for a major dislocation are present, and that the smart money is quietly preparing. You can prepare too. Or you can keep doing what Wall Street tells you to do and hope for the best. I know which approach has served me better over the past 20 years,